Knowing how to borrow smart is key to strengthening your overall financial picture and helping you reach your personal financial goals. Whether you need to borrow money for a big purchase, an unexpected car repair, or are looking to get a new credit card, there are many options out there. Step 1. Don't overextend yourself. Only agree to the credit or loan amount you feel comfortable borrowing based on your ability to pay it back over the time period, rate, and terms you can handle. Whether it's a personal loan, credit card, home mortgage, or school loan, too many people borrow more than they can afford to pay back and have difficulty repaying their obligations. This can result in higher borrowing costs, an impact to your credit score, and in some cases, loan denials down the road. Step 2. Pay your bills on time. Even if you can only afford to make the minimum payment, pay your bills on time to avoid penalties or getting bumped into a higher interest rate. Enroll in automatic online bill payment to have your bills paid automatically. Try to schedule your payment dates after your payday. If not, call your lender or service provider and see if they will change the payment date. Many will do so. Step 3. Pay more than the minimum. Whenever possible, pay more than the minimum monthly credit card payment or other scheduled loan amount. You'll pay down balances faster and pay less in interest charges. Step 4. Read your billing statements and terms and conditions. If you see changes in rates, errors, or suspect fraud, speak with the company at once. Immediately dispute any charges you don't recognize in writing. Step 5. Save your receipts so you can check purchases against charges on your monthly statements. Be sure to shred old statements and card receipts that you put in the garbage. Dumpster diving is one of the biggest sources of identity theft. Keep your account numbers, passwords, and other specifics someplace safe in case your cards or identity is stolen. Notify your card issuer immediately if you lose your cards. If your account data is in a smartphone or laptop, be sure to back it up elsewhere because those can be lost or stolen as well. There are two basic types of loans, secured and unsecured. Secured loans are tied or secured by something you own, called an asset. An asset could be a house, a car, stocks, bonds, or something else with a value equal to or greater than the amount you want to borrow. This asset becomes collateral that the lender can take if you don't pay back the loan or fall behind on your payments. Some of the more common secured loans are home mortgage loans, home equity lines of credit, and auto loans. Unsecured loans are loans that are not tied to an asset. The lender has no collateral to repossess if you default on your repayment, so the loan is made on good faith and based on your application, financial history, and credit report. Some examples of unsecured loans include credit cards, personal installment loans, payday advances, and other short-term small dollar loans, student loans, and unsecured lines of credit. Keep in mind that payday advances and other short-term small dollar loans are not appropriate for all situations. Managed properly, they can be useful when other options, such as incurring an overdraft fee or late charges, are more expensive. Always remember to compare costs and terms. There can be big differences between providers, and pay your loan off as soon as possible to save interest and fees. Now let's look at credit cards. A credit card is basically a loan from a bank, credit card company, or in some cases, a retailer. A credit card allows you to make purchases and get cash advances, then pay back some or all of that money, plus interest and fees, on a monthly basis. This allows you to purchase items now and pay for them over time. As you're weighing your borrowing options, these are some commonly used financial terms you need to know. Terms like credit limit. Your credit limit is the maximum amount you can borrow. With some credit cards, if you spend over your credit limit, you may be assessed a penalty fee. Minimum payment is the very least you can pay towards your outstanding loan balance and not be penalized. Minimum payment amounts vary based on the size of your outstanding balance and the terms of your loan or credit card agreement. To pay your loan off sooner, it's important to pay more than your minimum payment to minimize your interest and fees. Most credit cards allow a grace period, typically 20 to 30 days from the date of purchase to the due date for that month's charges where you're not charged interest or fees. If your card doesn't have a grace period, or if you carry an outstanding balance, you may be charged interest from the moment you make your purchase. So, be sure to read your credit card terms and conditions closely. APR is the annual percentage rate. The APR is the interest and other fees you'll pay on the amount you borrow or the balance you carry expressed as an annual rate of charge. The calculation is complex, but is required by law to be calculated consistently so you can easily compare different loan options. Your initial interest rate will be largely based on your credit score. In general, the higher your score, the lower your rate, and vice versa. Fees. Fees are additional charges or penalties your lender may assess you for various reasons. Some common examples include late payment fees, over-limit fees, overdraft fees, and ATM withdrawal fees. Be sure to carefully review your loan terms and conditions to make sure you understand how fees may impact you. To be a smart borrower, ask questions and make informed choices. Lending is a complex business. The real cost of borrowed money can escalate very quickly if you don't meet the terms and conditions you agreed to or didn't understand in the first place. The more you know about how to borrow smart, the better your personal financial situation will become. Check out the interactive tools section of this website to learn more about the best kinds of loans for your needs.